In this video, we talk about 10 things that you should quietly and quickly get done during your first 90 days of retirement. Coming up next on Holy Schmidt.
Holy Schmidt!
There's a window that exists during your first 90 days of retirement, and in those 90 days, what you do will shape the next 20 or 30 years. During that time, you make some pretty big decisions, and these decisions affect your finances, your health, and a number of other things. And these are what we're going to talk about now. First, let's talk about how most people handle the first 90 days. They walk out the door of the company that they worked for, and their calendar fills up immediately. They want to make sure that this happens. And some of the decisions we're going to be talking about just sort of happen on the fly, or they don't happen at all, simply because they'll get around to it. A recent Kiplinger piece by financial planner Kathy DeWitt Dunn put it this way: retirees often make decisions about Roth conversions, withdrawals, and tax planning based on what they read on social media instead of what fits their actual situation. And when those decisions go wrong, they don't cost hundreds of dollars. They cost thousands, tens of thousands, maybe even hundreds of thousands of dollars over a retirement. And these decisions aren't luxury items. They aren't luxury decisions. They are structural ones. And if you get these right, your retirement works with you, and if you get them wrong, your retirement works against you. Point number one is your withdrawal sequence. When you were working, the most important thing you could do was stuff as much money as you possibly could into the accounts available to you for retirement. That was job one. The moment you retire, however, the question flips. It's now, how much do I withdraw and from which accounts? Most retirees withdraw from a traditional IRA, or if they've maintained their 401k, from their 401k. But when you withdraw from either one of these two vehicles, and that increases your tax brackets, it could potentially increase the amount of tax you pay on Social Security as well. And 2 years later, that decision can also trigger something called IRMA. It's a Medicare term, and it's something we'll talk about in a little while. Now, before you withdraw a single dollar from your accounts, you need to know three things. The first is which account you'll draw from, whether year one is a window for a Roth conversion, and how to keep your tax brackets under control so that you don't pay more tax than you need to pay. The retiree who gets these right will pay significantly less tax in the future than the ones that get it wrong. And by the way, these 3 points are the foundation. They're the things you need to get right, because they are just about making the right decision with the information that you have in front of you. Number two is, what are you going to do with your 401k? Now, most retirees put their money into an IRA. They just roll it right into an IRA. That's autopilot. It's 101 stuff. But there are times when that's not the right decision, and times when it can actually cost you a lot of money. If you have company stock inside your 401k, there's a tax provision called net unrealized appreciation. That provision can save you tens of thousands of dollars, but only if you know that, number one, it exists, and number two, it's tied to your 401k. If you roll those shares into an IRA first, the NUA provision could be lost. So it's something that you need to talk to a tax planner about. Next, if you're retired age 55 or later, you can take penalty-free withdrawals from your 401k using a special provision. It's called the Rule of 55. But if you roll your 401k into an IRA, you lose the ability to take penalty-free withdrawals, because that provision is for 401ks, not for an IRA. In that instance, you would be forced to wait until you're 59 and a half once you roll it to an IRA. And many people, if they're not 59 and a half, want the flexibility to withdraw from their 401k. Third is creditor protection. Now let me explain what I mean. A 401k has federal ERISA protection. IRA protection outside of bankruptcy is state dependent, and it varies by state. If asset protection is important to you, then leaving your funds in your 401k may be the smarter move. Again, this is something that you should talk to a professional about. Next is fees. Some 401ks have access to institutional level shares, which means that you pay very low or no fees for being in certain mutual funds. But if you roll those same shares into your IRA, then you don't get that advantage. Conversely, some 401ks have horrible fees, and you want to get the money out as quickly as possible because the 401k provider is taking advantage. The important thing to note here is to compare before you roll, understand the fees in both situations. Next up is your retirement paycheck. Now you say, what's a retirement paycheck? Well, during your working years, you have funds that come in on a regular basis, and you can plan your life around those funds. But when you retire, a lot of that goes away, and you have to structure it so that you receive funds at a certain point of time every month or every 2 weeks, I suppose. But the important thing to note here is that unless you know that you need to do it, you will have a distribution as needed rather than on schedule, and that could actually disrupt your discipline around taking funds from your retirement accounts. Now, one of the things people talk about in retirement is a Roth conversion, but a Roth conversion isn't a yes or no decision. It's a timing decision. Bolden's Roth Conversion Explorer analyzes your income, taxes, and future RMDs year by year, and then runs multiple scenarios to help you optimize when or if converting actually makes sense. Bolden is one of only 3 affiliates we have on the channel, and it's the personal financial planning software that I personally use. If you'd like to try it free for 2 weeks, simply go to go.bolden.com/Schmidt, enter in your information, and you can try their full featured software free for 2 weeks. After that, it's $12 a month paid annually if you decide to keep it. Now, building a retirement paycheck is pretty straightforward. You only need to make a few decisions. How much do you want to receive every pay period? From which accounts do you want it to come from? And how does that work in coordination with things like your pension or Social Security if you have a pension? The retiree who handles this well in the first 90 days doesn't really feel the same retirement stress that a lot of first-year retirees feel when they figure it out on their own. And by the way, most large brokerages like Schwab, Fidelity, Vanguard will let you set up a periodic payment, and so you know that it's going to be arriving at the same time every month. You set the amount, you set the date, and the amount just shows up. This replaces the psychological benefit of a regular paycheck, and in a lot of cases, it stops you from pulling out large amounts of money without knowing how much you're actually spending. Number 4 is health insurance. If you're 65 or older, you have a 7-month window for what's called your initial enrollment period, and that's 3 months before the month that you turn 65, the month that you turn 65, and 3 months after. Unless you're born on the first of the month, then everything moves forward 1 month. So if you were born on April 1st, pretend that you were born in March. This window is there so that you can enroll in Medicare without any underwriting, and unless you're on what's called a creditable plan, it is the window that you need to get into Medicare. A creditable plan, by the way, usually is an employer-sponsored plan with 20 or more employees, either your employer, if you're still working, or your spouse's employer, if he or she is working. But if you're not on a creditable plan and you miss this window, then you could pay what's called a Part B penalty. Part B is Medicare's charge that they ask you to pay. Ask is a kind word. And you pay that every single month. But if you miss the window, there are penalties involved in that if you miss it by too much. If you're retiring before age 65, then you need to find health insurance in another way. Most people use the health insurance provided with the Affordable Care Act. You can do it online in most states, and you have a nice selection of providers there. It won't be cheap in most cases, but it is available to you, and so that's the place to go, or at least the place to start. Now let me connect this back to point number 1. When you apply for health insurance through the ACA marketplace, one of the questions they ask you about is your income. The higher your income, the more your health insurance could cost. There's a cap. So if you pull from a traditional IRA, for example, that's fully taxable. If you pull from a Roth, that's not taxable at all. And if you pull from your brokerage account, it may or may not be taxable. It depends on the gains on the investments. Knowing the cost of your insurance in the ACA marketplace is really important because you don't want that to creep up on you. And at the same time, knowing what the income levels are to reduce those costs is equally as important. The next point is your lifetime tax plan. Now you're saying, Jeff, what are you talking about? While you were working, tax planning meant maximizing your 401k contribution and maybe itemizing your taxes, and arranging your life so that you had more tax deductions versus less. In retirement, the decisions you make in year 1 ripple through the next 10, 20, 30 years in many cases. Year 1 is where you set the baseline for tax bracket filling. Roth conversions, if you're doing them, capital gains harvesting, IRMA management. That's all determined or set initially in year one and then revisited annually in many cases after that. And as a CPA, I can tell you this with absolute certainty. A lot of retirees, maybe even most retirees, don't think forward about their taxes. They think about their taxes when they're filling out their tax return, and by then it's too late. And just important points to note here for deductions. In 2026, the standard deduction is $16,100 for single filers and $32,200 for married filing jointly. If you're 65 or older, you get an additional deduction, $2,050 for single filers and $1,650 per spouse for married filing jointly. And there's a temporary age 65 plus deduction of $6,000 per person, which phases out above income of $75,000 if you're single or $150,000 if you're married filing jointly. This is in effect from 2025 through 2028. The point is this: once you know these deduction levels, it's the starting point to know how much you can pull from your different accounts without having to lose deductions or without having to pay additional taxes because you're filling up tax brackets that you didn't know you were filling up. Having an awareness of this is one of the most effective financial planning tools you can have in retirement. Number 6 is your Social Security strategy. And I can tell you this for a fact. I wrote a course called Social Security Simplified, and overwhelmingly people pick when they're going to take their Social Security based on when a friend or family member took theirs. There's absolutely no analysis whatsoever done on the choice. The right Social Security claiming strategy depends on how your Social Security interacts with everything else. It depends on whether you need the money or not. It depends on whether you're trying to optimize the survivor benefit. There are a lot of decisions. It's not just something that your neighbor did or your family member did. Once you start taking Social Security, your Social Security payment could be taxed, and there's something called provisional income. The provisional income calculation determines whether none of your Social Security payment is going to be taxed, up to 50% of your Social Security payment is going to be taxed, or up to 85% of your Social Security payment is going to be taxed. Note that I said going to be taxed. That's not the tax on Social Security. It's just how much of your Social Security payment is taxable. And just to give you some rough numbers on this, for married filing jointly, if you earn below $32,000 of provisional income, none of your benefit is taxed. Between $32,000 and $44,000, up to 50% of your benefit is taxed, and above $44,000, up to 85% is taxable. For single filers, the thresholds are lower, $25,000 and $34,000. So if you claim at the wrong age, it doesn't just affect your tax bill today, it could affect your tax bill for decades. Number 7 is your beneficiary designations. Now, for most people, when they fill out the forms for their 401k and frankly for their IRA, they pick their beneficiaries and that's it. They don't look at that again, even if their situation has changed. And it comes as a shocking reality check when someone doesn't make those changes, but their family has changed, and someone who wasn't supposed to get a significant portion of someone's 401k gets a significant portion of someone's 401k. The important point to note here is that your beneficiaries that you designated in your 401k or your IRA override what is in your will or your trust. You can't fix it in a will or trust. You need to fix it at the 401k or at the IRA beneficiary level. I've seen retirement accounts go to ex-spouses because no one updated the form after the divorce. I've also seen all of the funds go to one child because the beneficiary was put in place before the second and third children were born. So you need to audit your documents, and it takes about 30 minutes. Pull the beneficiary information for your life insurance policy, your 401k and your IRA, your pension, your annuities, and any other financial documents where there's a payout if you pass. Don't just confirm the primary beneficiary, also confirm the contingent beneficiary, because time passes and things do happen. It costs you absolutely nothing to do this and is one of the most impactful things on this list. Number 8 is your insurance. It's important to note that when people put insurance in place, it's usually put in place to cover events that happen during their working years. If you pass early and you wanted to pay for a child's college education, well, the funds wouldn't be there without insurance in many cases anyway. You have disability insurance in case something happens when you're working and you can't bring home a paycheck. But things change when you retire, and so your insurance needs to be revisited. Disability insurance is no longer relevant if you don't have an income to replace. Term life insurance may not be necessary if you have enough assets and your spouse doesn't need it anymore. Carrying premiums on policies that serve no purpose is just a waste of money. On the other side, as you enter retirement, umbrella liability insurance and long-term care coverage becomes more important, not less. Protecting your assets from a lawsuit or an extended care event matters more in retirement than it did during your working years. Umbrella liability insurance is inexpensive relative to what it protects. And long-term care planning is a lot more complicated today than it was back in the past. A lot of products aren't available anymore, but it's a conversation that needs to happen. It's something that needs to be considered as soon as possible, even before retirement, if you can do it. Number 9 is your tax withholding, and this is something that most people don't think about, even though they should think about it, because you need to have taxes withheld from your different streams of income. This is one that costs first-year retirees a ton in IRS penalties simply because they haven't thought about it. And here's the big issue. Pension payments, Social Security, and IRA distributions all have different withholding rules. Social Security, for example, only withholds federal tax if you specifically request it on Form W-4V. Pension and annuity withholding depends on whether the payment is periodic or non-periodic, and retirees should file the correct withholding form instead of relying on whatever the default is. IRA distributions, for example, default to 10% federal withholding for most types of non-periodic distributions, but there's no state withholding unless you ask. And most retirees do not realize their withholding is way off until they file their first tax return in April, and by then they owe an underpayment penalty on top of the tax bill. The fix is to set up the correct holding amount, depending on the source, or set up quarterly tax payments. The IRS doesn't care which way you do it, they just want you to do it. Number 10 is understanding how survivor income works. And this is one that frustrates me the most because in most cases, the one making the decision is also the one who goes first. It's not always the case, but mathematically, it seems to play out that way. Here's what happens when one spouse passes. You go from having married filing jointly tax brackets to single filing tax brackets. Standard deductions drop because you're now talking about one person, not two, but yet the payments from IRA distributions continue on. Social Security taxation thresholds drop. Remember, we talked about that earlier. You have one set of thresholds if you're married filing jointly. You have a different set, a lower set, if you're filing as a single filer. IRMA thresholds drop too. In 2026, the threshold for IRMA is $109,000 if you're single, $218,000 if you're married filing jointly. If you put this all together, the surviving spouse can pay a higher effective tax rate than the couple did on even less income in many cases. This is what's called the widow's penalty. And if an IRA is large, the widow's penalty doesn't last just for 1 year, it lasts for the rest of the widow's life. For many couples, this is one of the single biggest arguments for doing Roth conversions earlier, because you can convert the funds at higher tax bracket levels while there are two partners in the house. But you can't have that conversion if you haven't modeled it. You need to model your Roth conversion. And when's the best time to do it? During the first 90 days, not 10 years from now when one spouse has already passed. Now here's the big takeaway. The first 90 days of retirement isn't about celebrating. Yes, there's a bit of that, but it's about structure and process. The retirees who handle these 10 items, and a few others, I suppose, set themselves up for success for the next 25 or 30 years. The retiree who skips them spends the next decade trying to fix things that they could have fixed much earlier, and oftentimes it costs them a lot of money. And here's what makes this so hard for most people. Once you announce that you're retiring, your calendar fills up. It fills up very quickly. Everything from visits to family to friends that want to go on trips with you. They arrive on your calendar, and sometimes you don't even know how they got there. So the work needs to get done quickly and quietly before the world has a vote on what goes on your calendar. So here's your action plan. In the first 30 days, pull every account statement, every beneficiary form, every insurance policy, build an inventory, look at the totals. This is the diagnostic step. In the next 30 days, build the withdrawal sequence, set up the retirement paycheck, make sure that you have the proper health insurance in place, and audit your beneficiaries. In the final 30 days, run the Social Security analysis, calibrate withholdings, model the survivor scenario, and start the lifetime tax plan. If you don't want to do this in your head or on a spreadsheet, check out Bolden. Go to go.bolden.com/Schmidt and try it free for 2 weeks. If you like this video, check out that video. This Roth conversion window closes in 2028. This is Jeff Schmidt, and I will see you in the next video.